Of course, if we didn't have enough to worry about, we're on the cusp of another earnings season. Banks are set to report, and as Wall Street gears up for all these earnings reports, we've got inflation and Fed rate hikes to watch as well. There you're looking at the CPI expectations, which is coming out tomorrow morning. Here to help make sense of all of this, JP Morgan Asset Management's global market strategist, Jordan Jackson. Jordan, thanks for being here. So obviously we've got a lot to contend with, and I didn't even mention currencies in that mix, which our Jared Blickery was just laying out, has been a real headwind for the market. The dollar strength that we have seen, what central banks around the world are doing. I actually want to start there briefly, just talk about the headwind that currencies are presenting and how much that is factoring into your investment equations right now.
Sure. If we think about the currency and the impact to revenues, roughly 40% of S&P 500 revenues are generated overseas. So as we sort of think about the strength of the dollar overseas, as well as the weakening economic backdrop, particularly in places like China and Europe, a lot of these multinational earnings could very well be coming under pressure through the third quarter. But currency markets, I think, are very much sniffing out this weak sort of global backdrop and this challenging environment that global central banks find themselves in, particularly with the Bank of England and the Bank of Japan. On one end, particularly in the Bank of England, they're hiking interest rates to try to a certain extent, stabilize their currency, while they just finishing out buying bonds by the end of this week to try to stabilize the bond market. Very, very difficult environment for global central banks to try and navigate. And so there's certainly another layer of uncertainty and complication in the markets. And I do think this means that the dollar is probably going to remain pretty strong through the end of the year and into next year.
As Julie mentioned at the top, we're going to be kicking off this earnings season. Some of the banks, we're set to hear from them. And with that in mind, a lot of chatter around how strong the household balance sheet is. From your perspective and what you've been reading through, where are household balance sheets? And especially going into next year, what is that kind of tenor of the consumer likely to be?
I still think household balance sheets are in decent shape. I will acknowledge that we do anticipate another quarter of a buildup in loan loss provisions across banks. This would be the sixth consecutive quarter that banks have decided to build up those loan loss reserves, and that is certainly going to act as a drag on overall bank earnings. And I think it's very much them taking a slightly more conservative approach, just recognizing that just about every analyst and market participant is calling for a recession sometime in 2023. And so I think banks really just want to fortify their balance sheets ahead of that. But when we look at the data today, we certainly acknowledge that consumers have been dipping into those pandemic-related savings. They've also been running up some of their credit card balances. But I would argue this is more of a normalization in credit card spending and usage, not necessarily a consumer that's becoming overextended. If you actually look at revolving credit as a percentage of disposable income leading up into the pandemic, that number was sitting at around 6.5%. And now, after consumers decided to pay down some of those credit card balances over the course of the pandemic, that number has picked back up to around a 6% level. So to add to that, we haven't necessarily seen consumer delinquency rates pick back up meaningfully. So, I think today consumers are still in a decent shape. Labor markets are still tight. Nominal wages are still strong. And that could certainly provide some support for consumers over the short term. But again, as businesses become a little bit more sour about the economic outlook, you'll start to see those hiring freezes start to lead into job cuts and layoffs. And then that's when the consumer is really going to start to come under pressure.
Jordan, is the reality that the bear market is just not going to end until there is any whiff of a Fed pivot?
To a certain extent, I think that's fair. And the reason why the pivot is so important is because there's still room, right, for the Fed to actually be more hawkish. I know you've got the Fed that's signaling a roughly 4.6% terminal rate next year. But I think the real question is, when is the federal funds rate going to cross CPI? And I think it's going to cross sometime at the middle of next year. The challenge is I think it crosses at a higher Fed funds rate, not a lower inflation rate. And so I think the Fed, and we'll get minutes sometime this afternoon, I think it's certainly going to continue to show that while some committee members are concerned about a slowdown in the economy, they're still laser focused on trying to bring down inflation and, more importantly, maintaining that in their credibility as an inflation fighting entity. And so I think you do kind of have to see that Fed pivot because markets don't like higher rates. And the Fed may actually be in a position to do a little bit more over the course of the first half of next year.